Good evening, good morning, good afternoon, wherever you are. I'm in Miami, Florida, and it is the morning. It's 9 a.m. And in this video, I want to share with you how to not lose money in cryptocurrency. Because if you manage to not lose money, you're likely to make a lot of money. Because very rarely do we ever see a new asset class come out, and not to mention the fastest growing, most exponential asset class we've ever seen. And I think we have a lot of growth ahead. And before we jump in, I'm telling you, this video is going to be really important, so watch to the end. But people have been saying that my view in my content room is a green screen. Guys, it's not a green screen. This is reality, all right? And you can have a pretty cool reality if you listen to this video, all right? So let's go ahead and jump in. This is likely going to be the most impactful video you ever see within cryptocurrency. So if you get value from it, it's likely that other people will get value from it. So please share this with other people that are investing into crypto, because I'm telling you, if you can avoid this one mistake, you are likely to do very, very well. And the thing I love about crypto is it has the ability to change the everyday person's lives and retail investors' lives, because essentially we're pretty much front running these corporations and elitists and all the people that have too much regulation for them to put capital into crypto. So right now, retail has a huge opportunity to actually kind of close this wealth gap and get ahead of the majority of the large sums of capital. So I'm telling you, I think this is going to be the most impactful video. Let's go ahead and jump in. So this is the biggest mistake that people make. Most people say, hey, what is the quickest and easiest way to 10x my investment? I have literally worked with over 1,000 people within crypto. I've got tens of thousands of questions. And this is a very, very common question. And one of the most common questions I just got, or actually one of my favorite questions I've ever got, was from a girl named Sarah in our group. It was about a week ago. She said, hey, how did you make most of your money? Did you hit a home run with an ICO, so like an initial coin offering, or like a random meme coin? And my answer was, no. I spent 3.5 years focusing on business and income, investing back into myself through self-education, through masterminds, through books, courses, mentors, and everything that was left over after I invested into myself, I then put into a well-diversified portfolio that was value-driven within cryptocurrency. And obviously that's done very, very well. And our funds have also done very, very well for hundreds of our investors. So why would you even want to diversify your portfolio? Well, it's to balance the trade-off between risk and reward. The wealthiest people in the world understand how important it is to take calculated risks to ensure they have the highest expected return. So what is the highest expected return, or what is an expected return, I should say? It's the profit or loss that an investor anticipates on an investment that has known historical rates of return. It is calculated by multiplying the potential outcomes by the chances of them occurring and then totaling these results. So I'm going to show you some great examples here right now. So this is what most people do, okay? They hear about these people hitting absolute home runs with these meme coins. Oh my God, this meme coin did a 20,000% return, right, in 3 days. And if you would have perfectly bought here and perfectly sold at the very top, you would be worth X amount of money, right? There's things like that all the time. So they hear that and they're like, wow, I need to go buy meme coins, or I need to go buy these really, really small capitalized coins. But they don't realize is the further you go, and this is coinmarketcap.com, anyone can go to this site. The further you go, it sorts all these coins by the market cap list. And if you actually look up here in the top left-hand corner, there's now more than 14,000 coins out right now. And it sorts it by market cap, right? So the further you go down on the market cap list, the more risk that you're taking, because there's less capital, right? Number 31 has a $6.4 billion market cap. And if you keep going down, the market caps get smaller and smaller. So that really shows like the conviction within the market, right? The lower the market cap, likely the higher the risk the project has. And you can sort it, by page. Like if we went to number 100, this is Audius. It has a $1 billion market cap. But if we go all the way down to like, whatever this coin is, right, that has a, 208,000% return. Well, what's the market cap? We don't even know the market cap. And we don't even know the total supply. We don't even know what the circulating supply is right now. So this is likely really high risk. It probably has a really small amount of capital, because in the past 24 hours, it only had 323,000 go through it, right? So that's what you need to understand is the further on the market cap list that you go, the higher the risk, because there's less capital in it, less people that believe in it, and less conviction by the market, okay? So I'm going to share with you this. This is what most people do.
they were like, they buy Bitcoin first, and then they realize, oh my God, let me actually sell my Bitcoin and go buy meme coins and go buy all these low capitalized coins. That's what low cap stands for. So most people are designing their portfolio like this, right? They put like 80% of their wealth and not even wealth, just crypto exposure into meme coins, 15% into, low capitalized coins because they think, oh my God, I'm shooting for the next 10,000x. And then they put, maybe 5% into Bitcoin. So this is how you would calculate the actual expected return for that portfolio. So Bitcoin, right? Let's say that it has an 80% chance of doing a 500% return over the next 5 years. Okay. I think that's honestly pretty realistic, to be honest, given growth curves. I'm not going to go into that, but this is just an example, right? So an 80% chance of a 500% return. So that'd be 0.8 times 500%, which would give Bitcoin's expected return would be 400%. Okay. The small caps, let's say they have a 1% chance of doing a 5,000% return. Oh my God, a 5,000% return. That would be amazing, right? That'd be way better than Bitcoin's 500% return. Well, not really, because if you multiplied the probability of that happening multiplied by the percentage return, the small cap's expected return is actually 50%, right? You got to factor in the probability of these returns actually playing out. And let's go look at meme coins, okay? We would look at meme coins that has a 0.0139%. Jeff, how did you get that number? All I did was I went to the coin market cap. I looked inside the top 10. We have two, meme coins that have made it. Actually, Shiba's are now outside of the top 10, but let's say they're both in the top 10, all right? These two meme coins have made it, right? Which is very rare, and I'll show you how rare. You multiply or you divide 2 by the amount of cryptocurrencies, which I don't know why CoinMarketCap's kind of glitching right now. You guys saw earlier it was 13,000 coins, right? So I took the 13,000 coins. They must be adding a lot of cryptos right now to this platform. So I multiplied or divided the number of meme coins that have actually made it that high up, and divided that by the total amount of cryptocurrencies right now, which gave me a 0.0139% chance. And let's say it was a 15,000% return or whatever it was, right? It doesn't matter. I'm showing you how to calculate your actual portfolio. So that would be 0.000, because you move the decimal places 2 points, 139 times 15,000. So the meme coin's expected return is actually 2.08%. Okay, so now you need to calculate. That's of each coin or each sector within your portfolio. Now you need to actually identify what is the expected return of my total portfolio. So your expected return would be that 400% expected return for Bitcoin multiplied by 5%, right? Because you only allocated for your portfolio but 5% Bitcoin. So 5%, which gives you a 20% return for Bitcoin's allocation within your portfolio. The small cap, same thing. It would give you a 7.5% return because you only had a 15% allocation to that. And then meme coins had an 80% allocation to that and only had an expected return of 2.08%. So that would be a 1.664%. So your total portfolio expected return is 29.16%. Okay? So that's what you could expect to get based on the returns and based on the probabilities of those things playing out. Now, this is what more of like a prudent investor would understand. Okay, here's the thing. You guys can create all different types of allocations and be in different sectors. This is what I do in some of our like paid groups, and this is what I do for myself and for our funds as well. It's like maybe something for a beginning investor, you just hold, the top 5 in altcoins, 80% in Bitcoin. If you got more like of a growth oriented portfolio, maybe you do have some small caps, 3% small caps, 10% like mid caps, 25% larger cap, altcoins, and then 60% into Bitcoin. Or let's just say you keep it simple and you understand these different sectors and you've done research into these different sectors and you believe that smart contracts have the most value, which is honestly my belief. That's the majority of what we hold in our funds. That's the majority of what I hold in my own portfolios as well. I really do believe that smart contracts are the best. And the reason is because you can actually identify and get some type of sense of the value that this protocol has, because you can go look at their transactions, right? You can go look at how many transactions they've had over the last 24 hours, how many transactions they've had total. This is just blockchair.com, and you can go look at a bunch of different assets. You can also say, oh my gosh, well, let's go look at Dogecoin and see, why should I not own Dogecoin? Well, I probably shouldn't own Dogecoin because let's go look at the number of the different wallets that actually hold Dogecoin. And if you look, there's 30.9 billion. One wallet has 30.9 billion. The next wallet has 5 billion, 4 billion, 4 billion, 1.8 billion. So like the top like 6 wallets here for Dogecoin own like 30 to 40% of the total supply of Dogecoin, right? Which presents more risk, and then we'll go back to like, Cardano. We can see, are the transactions increasing? What these are, these different blockchains and smart contracts in particular, there's so much utility for the coin because every transaction actually generates a fee on the blockchain, which is they use their native coin for that transaction. So the more transactions, the more adoption, the more developers building on top of their unique blockchain, the more that the coin is actually being used, which we tend to see an increase in the price of the coin, right? So like with Harmony, we can see, oh wow, the number of wallets is dramatically increasing, right? Over time. We can also see their transactions per day are over 2 million very, very consistently, right? So that's something that we're looking at is like the growth of transactions, the growth of the wallets, the number of NFTs being minted on the chain, all those things, right? So that's why I invest into smart contracts and believe they have the most amount of value. So let's say you understand that because you actually educated yourself and you do something like this, right? You keep it very simple. You hold 60% of the Bitcoin and you hold the top 5 smart contracts. Well, what are the top 5 smart contracts? Well, you can just go to another site, which is Masari.io. You can go to Screener. You can click on smart contracts. You can see the top 5 smart contracts right here. So let's say you just buy the top 5 Ethereum, Solana, Cardano, Polkadot, and Avalanche, right? You buy those top 5 in your portfolio and you calculate it. So let's say that Bitcoin, again, has that 80% chance of a 500% return. That would give you 400% once again. Smart contracts, let's say they have a 60% chance of doing a 2,000% return. And you're probably like, dude, that's so stupid. There's no way a 2,000% return. Well, I mean, I'll just share you with you. This is the total crypto market cap for all coins. I mean, let's go look at from like where we were at literally in 2017, right? If we go look at this, we had a 514% return from today, which is November 17th. In literally 48 days, the altcoins had a 514% return, okay? And if we zoom out, that's absolutely minuscule to where we're at now, right? And we're not even into this last growth phase, the most growth we're likely to see within crypto. So to have these type of returns, it's honestly not crazy. And I think that, the market cap of where we're at in crypto is very minuscule to likely where it's heading. And if you don't believe me, just go ask the World Economic Forum that's predicting it to be about 12.6 trillion over the next about 4 years. And the total value of crypto is still under 3 trillion right now. So I believe we've still got a lot of growth. So anyways, right? 60% chance of a 2,000% return. That gives you an expected return of 1,200%. Let's multiply by the actual allocations we had in the portfolio. And we did, 60% of the portfolio of Bitcoin, which is, a 240% expected return. The larger caps, so the smart contracts that we had, I have a 480% expected return. So the actual expected return of the portfolio is 720% relative to someone that was shooting for the home run of the meme coin. Their expected return is 29.16%. Would you rather a 29.16% expected return, or would you rather a 720% expected return? These are the types of things you need to understand is asset allocation within cryptocurrency. Another big mistake that people make is like, hey, I feel like I need to trade and be in and out of this coin and that coin, and I need to like actively manage everything. Like, you can keep it simple. You could dollar cost average into your own like investment portfolio, or invest into like different funds that practice proper portfolio allocation and asset allocation, and maybe they actively manage part of their portfolio. Because what you need to understand is this: there's a balance between risk and reward. This is the thing you need to balance. And if you consistently lose money, you're going to be on this hamster wheel where you just keep losing and losing and losing, and you're never going to get to the point where you even see any type of a compound effect with the investments that you make. So you need to understand this balance of risk and reward, and understand when these meme coins, they have a really high rate of return. Oh my God, 15,000% return, right? When they have a higher rate of return, well, guess what? The probability of that actually playing out is likely lower, right? We're on a seesaw here. You need to understand this image to actually make a difference in your expected return in your portfolio. So now you're probably wondering, okay, how much risk do I take? The different sectors have different types of risk, right? You can go, like, you need to find out what avatar you are, right? Maybe you do want to go more high growth and you want to trade with some of your portfolio. You want to have maybe, you allocate more towards mid caps, more towards large caps. You've got a aggressive strategy like this where you've got like 50% into large caps. You hold a 20% Bitcoin allocation, and then you're more heavily into mid caps and small caps as well. And then you also need to understand like your total portfolio, right? Like a traditional financial advisor might recommend for like a young person, oh, let's say, put 7% of your portfolio in crypto. I have much more than that, but and I'm not a financial advisor, so I have no idea what you should do. But you got to put this into a visual for yourself and say, how much money do I want to have in crypto? And the reason is because you need to understand this. So if you're this guy down here in the bottom left-hand corner, all right, and you're worth $10,000 today, okay, let's say you want to be worth 100 grand in 20 years. Well, you could easily invest that 10 grand in like the S&P 500, and in 20 years you'll have more than 100 grand. Okay, just based on previous, growth, right? So that's very easy to do. So that would be this arrow in the middle. That's the gap that you need to bridge, which is about 90 grand, right? Over 20 years though. So that's very, very plausible. But let's say that you have that 10 grand right now. You're this guy in the bottom left-hand corner, but you want to get to 1 billion, right? You up here is $1 billion. So the gap is from the 10 grand to the $1 billion. That's a much bigger gap. So what you need to understand is if you want a much higher return, you're probably going to have to take more risk to get that higher rate of return. So you need to understand, but there's always a balance, right, that you need to understand of this risk and reward. But if you've got higher goals for yourself, you likely need to take more risk. So maybe you were to, maybe your financial advisor you recommends that you only have 1% exposure to crypto, but you have conviction in the asset class and you really want your net worth to, go from 10,000 to 1 billion. Well, maybe you do increase that amount of allocation within your investment portfolio to have a higher potential expected return, right? Now, those are questions you just need to be asking yourself. And that's not the only question. I think this is the most important one, is your goals, because if you get to the end of your life and you realize that, wow, I didn't do anything that actually would even get me close to my goals, that's a really, really big mistake. I think that's probably the worst mistake, is you get to the end of your life and you realize, wow, I was doing the wrong things my entire life, right? So you need to be asking yourself these things. And a few other questions you probably need to ask is, and when evaluating how much risk you want to take, is, your goals, which we just went over, your understanding of the assets, right? So if you don't have conviction and even understand the assets, it's probably not a good idea to invest in, because you're going to make emotional decisions, which is number 3, when it gets really volatile, which obviously crypto is very volatile. I mean, let's look at what, not just look at the upside, let's look at reality as well. As like after we went up, 500% in 40 days, we also went down about 91% after, from the very top, obviously, to the very bottom. But then if you look over time, right, it's not even comparable. So you need to understand that. But like, if you don't understand what you're investing in, you're likely to make a really big emotional mistake, buying highs and selling lows, which is obviously not what you want to do. So you got to have some ability to control your emotion. If you don't, you probably need to invest with someone that does and specializes in that. Do you have dependents, right? Do people depend on you, right? If you got an entire family, maybe the amount of risk that you take is less. Your level of income, right? If you have a really high level of income, you can take more risk because you've got income coming in. If you got low income, you probably can't take as much risk, because if you lose that money, there's not money to replenish what you just lost. And then also your entire investment portfolio risk, which is what I was talking about, like how much is in real estate, stocks, crypto, bonds, all that stuff, right? And then your risk tolerance, which this whole video is trying to get you to think about your risk tolerance. All right. So what you need to understand is this still applies. Even though Warren Buffett thinks like crypto is rat poison, which I completely disagree with, because what we found is really intelligent people and successful traditional investors, they don't understand investing into protocols. They understand investing into, free cash flow in a business because they're value investors, and that's what they've done their whole lives. They can't even comprehend crypto is investing into a protocol. It's not investing into a business. This is a whole new shift of investments that we're seeing, right? So, and by the way, I believe most crypto is nonsense. It's completely it'll likely be worth zero, but there's a lot of cryptocurrencies that will actually, and blockchains that will absolutely revolutionize the world and how, the world and business operates. So anyways, rule number 1, never lose money. Rule number 2, don't forget the first rule. So you need to do your best job to stop losing money so that the compound effects can start to take place and you can be in a much better spot in your future. Okay? If you got value from this video, I greatly appreciate you hitting the like button.